Okay, perfect. All right. Um,
Is everybody admitted?
we are recording. Yep. Okay, I think we're good to go.
Okay, great. And I think everybody has been admitted. Sorry, we had just a slight bit of technical difficulty and we're now on a roll. Welcome to our fourth quarter employee benefit compliance training. First off, I do want to give a shout out to all of you who, many of you are in the midst of your open enrollment seasons. And we really appreciate your business. Thank you for your participation. And for those who couldn't attend today, there will be the recording available. So, moving on, let's get started. We are going to today really primarily focus on the ACA, the Affordable Care Act, and and we're going to highlight the applicable employer group rules. We are going to discuss the shared responsibility pay or play rules. We will also touch on a few other ACA deliverables, identify who is responsible, who else could be responsible in some cases, and why each of those activities is important. So again, welcome. Our next external compliance meeting will be on the fourth Wednesday of February in 2026, not 2025. Sorry about that. And so that will be at a regular scheduled fourth Wednesday of the month of the second month of the quarter. So hopefully we will get all of that and scheduled for you. So moving on, I just want to highlight some important activities for the 2026 plan years. So whether you're a calendar year plan or you are new and renewing or renewing at a different month during 2026, some things to consider. I like to remind people to really confirm your state benchmark plans. Of course, the fully insured carriers and health plans already baked into their state mandated benefits. They do pick up those state benchmark rules. As a self-funded plan, you can determine which state benchmark plan you would like to use. And it does not have to be the one that you're headquartered in, nor does it have to be the one where most of your employees are. When I was working for a Pacific Northwest organization, for example, many of our self-funded plans used Utah. So whether or not Utah is still a lower cost option, I'm not sure, but it is time for you to really think about what changes there might have been with those state benchmark plans. You will want to then, of course, identify the limits on those cost sharing for those essential benefits. And then, as a reminder, and we will talk about the Supreme Court case a little bit later, is the U.S. Preventive Task Force. Category A's and B's it was upheld by the federal government. So plans must adopt and it's the first of the plan year following 1 year of adoption. So if the U.S. Preventive Task Force adopted a new category A or B preventive care, they would on say May 1st of 2024, you would go out 12 months and then it would be the first day of your plan year after that those need to be adopted. So make sure those are also outlined or referenced in your plan documentation as well. It's also time to think about your summaries of benefits and coverage. Were there any changes made mid-year or towards open enrollment that may impact those summaries of benefits and coverage? And then ensure that you also have, if you have more than 10% in any where English is not the primary language, and you have more than 10% of your enrollees, you should also provide it in that language. And then there was a couple more recently, the IRS once a year does produce a revenue procedure bulletin. In this case, it's 2025-25 and 26. The 25 addresses the affordability percentage, which did increase to 9.96%. And then 2025-26 discusses the actual penalty, which in the initial year was $2,000, and that has been inflation adjusted over the years. So in 2026, that is now $5,010. So the good news is from the affordability percentage, that was favorable to plans, and it will make it easier for affordability calculations and meeting that affordability of those plans. The bad news is that the penalties themselves have will increase. However, due to some of the subsidies that have expired, as which are due to expire at the end of this year, there will be less possibility that, or less individuals that could enroll in the exchange. So there should be that increased penalty should be offset by less people going to the exchange. And then I've identified on the slide for you for 2026 your ACA limits that you should pay particular attention to. So if those do apply to your product offerings, make sure that those are visited. You may also want to make sure that you communicate that to your employees during open enrollment. And then also a reminder of those as the calendar year is ending, that you remind your plans if you do have the health FSA, dependent care assistance programs, that you remind them to get those claims in and then let them know whether or not you have a grace period or you have the dollar carryover. So, one thing to keep in mind is prior to last year, there was guidance given that you did not have to deliver the 1094 B and 1095C notices to individuals automatically. Many of you probably have that process in place after all these years and want to continue to do that, and that's great. But if you choose to just upon request issue one of those notices to the employee within 30 days, then there are some requirements on posting, similar to requirements under ERISA for posting, making sure it's visible and that people know that that will be done electronically. And then just a couple deadlines to keep in mind is the 2025 ACA return, if it's done electronically, must be done by March 31st of 2026. And then again, going into the new year, if should you still have a grandfathered plan, that you evaluate whether or not you want to maintain that grandfathered status. If you do, then you want to be sure to provide that notice so that the employees of those plans are given their rights, especially during open enrollment. So again, if we maintain compliance, it should minimize potential penalties, especially in this area under the Affordable Care Act, and maximize your employee benefits. And remember, compliance is a journey. So just high level, let's touch on the shared responsibility and let's talk about some of the key provisions under the shared responsibility of the Affordable Care Act. It's really designed so that most employer groups, including governmental agencies and not-for-profits, that they must offer health coverage to full-time employees and their children through the age of 26, not 16. I apologize for that. They must offer minimum essential coverage and it must be affordable. There are some penalties for not complying as an applicable large employer, and we'll discuss how to measure to determine whether you or not your plan is or your employer is an applicable large employer. There are penalties under this IRS code. It's the Internal Revenue Code, Section 4980H. You'll hear that often referred. There's an A penalty and a B penalty. And the A penalty is really for failing to offer this minimum essential and affordable coverage to at least 95% of your full-time employees. And then there's the B penalty, which is for not maintaining affordable or minimum value coverage. The affordability standards are really based on household income. Most employers don't receive the household income of their employees. So the IRS has, or this code section does provide for some safe harbors, which we will get into the three different methods that can be used as employers don't typically receive that information. We're going to talk about the full-time employee definition. Keep in mind that in order to determine whether or not you're an applicable large employer, the definition will include full-time equivalents. But when you actually get into assessing penalties, under this code, you wouldn't the penalties are not assessed on the full-time equivalent. So you really need to pay attention to when full-time equivalence is utilized. A full-time employee generally are those that work 30 plus hours a week or 130 hours a month. Now, benefits to employers. Again, we spoke about mitigating or preventing penalties under this code section, but this is also designed to increase employee retention and satisfaction. Health coverage has been known to boost morale, reduce turnover, and also aid in recruitment. Under this provision, there's also some tax credits that may be available for employers with less than 25 employees. I will not do a deep dive on that. So if you feel like you're in that situation, please be sure to reach out to your legal advisors or certified public accountants. The other benefit to the employer groups is the predictability and budgeting. Within the ACA, they also provide some ACA calculator tools that will help support cost planning. Some of the safe harbor methods that we discuss will also help kind of smooth the water for budgeting and predictability as well. And ultimately, it should reduce further financial risk from audits and other legal issues for noncompliance. Now, we've already touched on some of the benefits to employees and dependents. It's really essentially the access to affordable healthcare coverage that is minimum value. It is designed to cover dependent children up to age 26. Again, a spouse is not required to be covered, but there will be some reporting so that when you do file under Section 4980, that you will file whether or not you are also offering coverage to employees only, employees and spouse, and children. So those details will come into play when you're actually filing those returns. The minimum essential coverage hopefully will provide protection against high medical costs. It will help reduce out-of-pocket expenses to your members, which will ultimately hopefully result in improved health outcomes. There will be certain preventive care, again, that are covered without cost sharing to urge them to seek that treatment before things get escalated. There are some some employees that will still be able to receive the premium tax credits should you not offer affordable and minimum essential coverage. And we talked about the tax credit as well. So moving on, the Internal Revenue Code section for the shared responsibility is Section 4980H. It starts by you first need to identify whether or not you are an applicable large employer. And if you meet that category, which should be evaluated every single year, so now we should be using 2025 data to evaluate whether in 2026 you need to file as an applicable large employer or a non-applicable large employer. The Again, this is where you use the definitions of both full-time employees, which are those that average 30 hours plus a week or 130 hours per month, versus full-time equivalents. And full-time equivalents are essentially aggregating the hours worked of employees that work less than 30 hours a week, aggregating them and dividing by the number of individuals. We will show you an example. And then it will determine based on the applicable large employer status whether or not you need to move forward and either pay or play. So this is again a reminder of the full-time equivalents, and we'll get into an example. Keep in mind that when you're aggregating full-time employees, you do not have to cover veterans that have coverage elsewhere. There are also some rules over seasonal workers. So if in the last year your seasonal workers caused you to exceed the 50 full-time employees plus full-time equivalents, and that excess of 50 was due to those seasonal workers, then you do not need to include those in your counts towards the applicable large employer. So the example on the and oh, I'm sorry, there on the side too, you will see that there are some things that we talked about the seasonal workers, temporary workers. Typically, they do work for agencies. They operate as independent contractors. You do not have to offer coverage to independent contractors, but there are some, read your agreements, that do that. And then those do need to be counted. And then hours when you're counting, especially for the 30 plus and the aggregation of the full-time or the calculation of the full-time equivalents, you do need to include paid hours such as vacation, holiday, illness, jury duty, layoff, military, leave of absence. Again, that's paid leave. So that would also be taken into consideration. Within the applicable large group rules, if you're an employer that has many different affiliates, there is something called the controlled group rules that also need to be evaluated. It is really important that you seek your legal advice and your CPAs on this. We oftentimes get asked to weigh in with respect to employee benefits. We can give some guidance regarding that, but we need to recognize that what we do from the employee benefit standpoint and whether or not we consider somebody a controlled group or not is the same for other tax returns that these groups also need to file. So it's really important that you work with the producer, the group, and employee benefit compliance and your CPAs to ensure that everybody's in sync on those control group rules. Now, moving on to the example, in this case, it's showing that there were 35 employees that work 30 plus hours. So that's easy. We can count those 35. Then it indicated that there are 20 individuals who work less than 30 hours. When you aggregate their hours under for the year, it totaled 1,920 hours. You divide that by 120, and you will add 16 to that. So you, in this case, this employer would be an applicable large employer because their full-time plus full-time equivalents exceeds 50, and it's 51. All right, moving on. So, temporary and hourly workers, there are two different methods that can be used because it's very difficult oftentimes to understand whether or not an individual is really going to work full-time hours on average of 30 or not. So, plans can use the monthly measurement period where for each month they're looking to see whether or not that employee exceeded, full-time or part-time hours and whether or not that offer of coverage needs to be made. In the other case, it's the look back method. And the look back method is typically used where you have a high variability of hourly employees that you're not really sure. Yesterday, we had received an example where somebody was hired just to be on call. So it was not clear whether or not they were able to achieve full-time status or not. So a group under the look back method has the ability to look back, and we'll talk about that. So again, the monthly measurement method is month by month. There's no averaging in this case. You must use the same method for aggregating for all employees. There can be a 90-day grace period following hire. So, as long as individuals have coverage beginning the first day following 90 days of work, you will be in compliance with the law. And there are specific coding instructions as to how to code when they're in that 90-day period or they're in that period before their coverage begins. Now, the look back method, as we discussed, is for that variable hourly employer. There are really three periods of time that you can, this method looks at. There's a look back method, and you can look back at employees and you can go anywhere from go back 3 months to 12 months. 12 months is the maximum, and so that you can assess whether or not those individuals have achieved full-time status or not. Then there's an administrative period of up to 90 days. And again, that's an up to 3 months for administrative and being able to disenroll and enroll individuals in coverage. And then there's the move forward period or the stability period, as it's called, which is where you must continue then to offer the coverage for each of those months during the stability period. And you can do that, again, you can do that measurement annually. You just need to be very consistent. Um, let's see, I think we've covered the majority of this. Keep in mind, oh, I'm sorry. So this is about the minimum value and affordability of coverage. So under minimum affordability, things to keep in mind are that HSA contributions counts towards first dollar coverage. So that could, your employer that contributes to the HSA could contribute and to help you achieve that affordability. For HRAs, co-payments are not premium, and so those do not count towards the minimum value. And then also remember that for non-discriminatory or wellness programs, that some of those are in certain states considered discriminatory, and to be sure to follow those rules. Now, as to affordability of coverage, Um, Really, the HSA, other than the contributions that the employer makes, there's certainly no impact on the affordability. Moving on to the actual returns and the process itself, I mentioned that there are different methods for reporting to employees. You can actually provide a 1095-C notice to employees. If you do it in paper, it must be done by January 31st. For if you're choosing the paper methodology, then that filing is due February 28th as an employer. And if you are using the electronic methods that we talked about earlier, then March 31st is that deadline. So keep in mind those deadlines. So again, you have the transmittal and summary, which is the 1094, either the B or C, and we'll talk about the Bs. And then you've got the Form 1095-C, which is provided to the employer. Now, there are various sections, code sections under this. So sometimes they're referred to as 6055 and 6056. The key thing on the right is to keep in mind that if you're a self-funded, applicable large employer and you have fully insured coverage as well, many offer both a fully insured and a self-funded, they can be done in a combined filing. And so there is, and you can add the self-funded to part three of that code section. And then under code section 6056, there's also an obligation for self-funded employer groups that are did not meet the definition of applicable large employer. Those also have the transmittal. So they have the 1094B transmittal that they need to file, again, non-applicable large employers that are self-funded, and then the return to the individual, again, upon request, if you're doing it electronically within 30 days, is the 1095B. And then for the fully insured plans that are applicable large employers, again, that is code section 6055 and 6056, as noted. So, high level, these are the rules that I referred to earlier. If you do wish to just furnish the notices to the individuals upon request within 30 days, then you must post on in a clear and conspicuous place a notice on your website by March 2nd. So please make note of that date if you're not going to use the automatic and automatically send to all individuals. And that notice must include specific information. You do need to retain those notices so that you have that for support should the federal government or any agency choose to audit. And again, if you're in you must fulfill those requests by January 31st so those individuals can file their taxes. All right. I'm a hockey mom and I never liked to see my children in the penalty box. But so likewise, I don't think any of you want to be subject to the penalties either. So we will talk about the penalties that can be assessed, whether it's the A penalty or the B penalty. Again, key components that you need to watch out for so that you aren't in the penalty box is that making sure that you have minimum value, affordable coverage, ensuring that your individuals do not seek coverage on the exchange and receive premium tax credits, especially if you have provided affordable coverage. So you may, during your enrollment meetings, maybe address with them that yes, you are offering to all employees that affordable minimum value coverage and that they should not be seeking premium tax credits or cost sharing reductions on the exchange since you have done that. Now, for those that don't have the minimum value plan, then there is that risk of that penalty if the individual goes to the exchange and receives that premium tax credit. So, guess what? You do have an option to just pay. So you do not have to provide that minimum, essential, and affordable coverage to 95% or more employees, and you can just go directly to the penalty. Most groups have not chosen that method. The play method again, we've gone over these rules. Let's touch a little bit again on some safe harbor exceptions. So when you look at minimum essential coverage, there are essentially what you're trying to do is achieve 60% or more of the total allowed cost. There are different methods that are provided for to be able to identify whether or not a plan has met that minimum essential coverage. Historically, the fully insured carriers and health plans have done that evaluation for you and have let you know that. We are seeing in compliance that clients are actually receiving notices from some of those carriers that they're not going to do that calculation anymore. And what they've done is they have identified the criteria for which you would measure and the safe harbors that you can use to determine and the various methods that you can use so that you do have a safe harbor should your plan not exceed that 60% cost. Now, I have noted in reviewing some of the letters that a couple of the larger carriers have omitted a couple of the criteria. This is a great place to go to XyWaves, which is available to all clients, and you can look up those rules and specifically get information on each of these checklists and methods that I'm just going to touch on high level. So there are some options that are just based on plan design, and you can see that there are three different options. The first two do depend on whether or not it's an integrated plan, meaning the medical and the pharmacy are integrated as to the deductibles. You can see option three has separate deductibles for the medical and the pharmacy components. So out of the gate, you can just design your plan that way. The second is the Health and Human Services has provided a calculator that you could use. It's a very simple calculator that can be used in some cases where you have more standard plans. That method might work for you. Those access to that is also available using XyWaves to get to the website where you can download that calculator from HHS. The other best method is to retain actuary to actually do that evaluation. Especially, this is really important where you're going to have some non-standard provisions so that they can evaluate the total cost of your plan of that allowed cost. And then lastly, for small groups, there is an ability for, again, small groups to use medal levels. And you can use any of the medal levels and compare to the plans that are on your exchange. So we touched on these, but you can see I've laid out here the 2026 and the 2025 comparisons. So you have the A penalty amounts, which are usually applied. Again, those are adjusted, inflation adjusted since the inception of, I believe it was January 1st of 2015 was the first year that this came into play. Um, Even though the ACA was passed more than 15 years ago, March 23rd of 2010. But that adjustment is inflation adjusted each year. In 2025, for the total year, it was 2,900. And in 2026, that increases to 3,340. And then likewise, the B penalty, that I think I misspoke earlier, was $3,000 originally. That has been inflation adjusted and went from $44,350 to $5,010 for this year. So again, those amounts are not favorable, but it is anticipated that if they do, in fact, if the Senate does not pass and they do expire at the end of 2025, that there will be less people that will be eligible for obtaining premium tax credits. And then the affordability percentage went from 9.02 to 9.96, and that is favorable to the plans. All right, so just out of the gate, if you want to look at the A penalty, then what you do is you add up the number of full-time employees. Again, this is a case where it's now not the federal or the full-time equivalents, it's just full-time employees. You subtract 30 and then multiply it for each month. That affordable coverage was not provided to 95% by the applicable monthly amount. Under the B penalty, again, that amount, the penalty calculated is $5,010 or $417.50 per employee that goes and obtains premium tax credits and cost sharing reductions on the exchange. Now, things to be thinking about is that unfortunately, you as an employer do not know that somebody has gone and sought coverage on the marketplace and obtained those premium tax credits for quite a period of time. The IRS, so you'll do your filing each year, but the IRS will eventually catch up and will provide a Letter 226J notice if there are individuals that went on the exchange and they believe that your filing is different and that they believe you should be assessed a penalty. When you get those notices, pay particular attention right away. There are strict timelines. In some cases, they will actually ask you to pay the penalty up front while you're providing that support and then recover. So a pay and pursue strategy. Be very particular on those deadlines. Just note that this year in 2025, we know that employer groups were receiving the 2022 year penalties. Even with the government that had been on pause, they do expect to build in some efficiencies. So in next year, it is possible that you will receive notices, our Letter 226J notices for the 2023 and 2024 years by the end of the year. So they do expect to get caught up on that. Now, with respect to the calculations that goes into the actual filing, where you're going to track each employee, you're going to identify if they were offered coverage, you're going to code a table and identify whether or not there's any special coding. We're going to talk about the codes in a minute, but just so you know that there are really three safe harbor exceptions to affordability that can be employed by your plans. Ideally, classes of individuals should use the consistent methodology. The W-2 method, for example, is used where your employee is primarily salary based and or if you have a category of employees salaried, this is oftentimes the W-2 method. Safe harbor is usually easiest. It is actually pulling box one from the form W-2 to determine whether or not you meet the affordability for that individual. The federal poverty level method is the easiest, but it is probably on average the higher cost method because it's simply looking at the federal poverty level. I looked and I did not see what that is for 2026 yet. I think we have an example coming up of 2025, but essentially you're taking that federal poverty level and multiplying it by that affordability percentage of 9.62% and dividing it by 12 to spread that over and comparing that so ensuring that if your employer contributions exceed and or that your employee contributions stay below that, then you'll meet that affordability. And then if you have a highly hourly employee or cyclic or variable where there's ups and downs as far as how many hours or seasonality to that hourly workforce, then the rate of pay method may be the best method for you. That's where you're going to compare the salary on the first day of the month and each month, and you're going to take the lesser of and apply that 9.62%. Now, this method implies 130 hours for hourly. So if your hourly workforce does not on average work 130 hours, this method may or may not work or may not be the best option for you either. It does assume the 130 hour per month for those part-time employees. Now, the actual form itself, there is really good detailed instructions on the IRS website. There's also some good summary guidance on approaching the ACA. I do want to mention that Xywave's just recently published, they call it the ACA Toolkit. If you go on Xywaves or ask your producers, they can help you locate them. That ACA toolkit, it really is a good summary of what we cover here today, and it gets you into enough of the details so that you can ensure your compliance under the employer shared responsibility. Just high level, the forms as you're filing them have, part one, which is explaining the employee and employer information. There's information on the offer of the coverage, and it'll get into some detailed codes again surrounding whether or not coverage was offered to an employee only, employee plus spouse, employee plus dependent children. So pay attention there. We already discussed that if it's a fully insured plan and there's also a self-funded plan that runs alongside it, that for those applicable large employers, that part three is where you can add the self-insured details. And then now you're getting into codes. I'm not going to go into each and every definition of codes, but there are different code sections. Like there's a code one series and there's a code two series. The various series, one is really about coding each employee so that whether or not they actually had coverage or not. So let's say, for example, an employee comes on mid-year, the first maybe 6 months they weren't offered coverage, but then the last 6 months they were. There are codes that need to be put in those boxes and different ones for the first 6 months versus the second, the latter half that I used in that example. If an employee has been enrolled all year in that minimum value coverage and they were offered that coverage all year long, there is an option for you to select a box that says apply this to all 12 months, or they were very nice, or you can go and put that code instead of Xing that box, you just put that code in each of the 12 months, January through December. So there are some options there. There are some codes also regarding individual coverage. I won't go into those, but just note there are those codes. And then the code series two codes, as you can see, is they're coding maybe that they weren't employed for the month, that they weren't full-time coverage, etc. So there are very detailed code and really good instructions. As I mentioned before, we talked about the look back method. In that look back method, while you're doing that evaluation, there is something called the limited non-assessment period, which is made up of the first two periods that we discussed. So it's anywhere from 3 to 12 months for the actual look back period. And then you have an administrative period, which can be up to 3 months. So you can code certain codes during that limited non-assessment period if your employee fell into that category. And then we already discussed the affordability that employees cannot contribute more using, and again, the safe harbor. So those contributions cannot exceed using the three different methods. Again, you must be consistent within a category of employees, but you can have different, again, for salary versus hourly if you wish. We did speak about the letter 226J notices. There also, just so you know, there was a challenge. There's been many challenges to the ACA. One of them was this reporting because there was a case that said that the HHS did not have the authority to assess the penalty and the filing responsibility with the IRS. At this point in time, everybody still has to continue to file. Should this case be decided, then the world will have to reevaluate. But at this point, if you do get a letter 226J notice, you may want to reach out to your legal advisors and ask them whether or not you want to just footnote that there is this decision by the Supreme Court out there that they can, and you might just note that. Again, you're not off the hook. You still need to file and you still need to pay penalties. It's just you could, as a practical matter, just note that, but work with your legal advisors on that. Remember, again, there could be the IRS when they send you that notice. They may be very clear about assessing and asking you to pay the full amount and then provide support for recovering or getting back a refund. So it's a pay and pursue strategy that it is a little game of ping pong. Again, the IRS has been very amenable to receiving support that does help reduce those penalties. We've been asked to give input at times. We do not do these calculations. You are in the best position to use your payroll vendors who are accustomed to pulling the various reports that are required, whether you're using, depending on what method and safe harbor methods you're using. Likewise, there's also some really good vendors out there that are really good in this space and can help you abate some of those penalties should you get assessed large penalties. So feel free to reach out to your producers. We in the compliance department do maintain a list of vendors that are pretty good. The last thing I would say is you do need to get on, if you do want them to help you with that filing for 2026, you do need to get scheduled now if you're going to meet the deadlines that we discussed previously. In summary, you really need to plan strategically, evaluate the pay or play rules, work with your payroll vendors, service vendors, your producers. Also, um, the TPA themselves, the plans and the carriers, they're really not in a good position to do this reporting for you. They are good at supporting who has enrolled, and they should be able to provide information or supporting reports so that you can ensure that you're filing appropriately. But many of those do not have, they only have positive enrollment. They don't have negative enrollment. And that's where somebody's been offered coverage, but they didn't take it. That is core critical to the success of this filing. So just note why that while they can help you, they're probably not in the best position to do that for you. So just high level, again, we talked about the meat of the ACA, but of course, there are many other obligations under the Affordable Care Act. There are notices. Many of you are right now in the midst of putting together your open enrollment materials, as well as your summaries of benefits and coverage. You so for many of these notices under the ACA, and I'll point out a couple, some are only required once. Others you need to do on an annual basis and supply. And in addition to putting them in the open enrollment packet, in some cases you need to have a paragraph or a blurb in your policy or your summary plan descriptions. So don't forget about that. I have reviewed some summary plan descriptions recently that do not have all of those noted. So make sure that those are also noted. You can work with your producers on those rules. So just high level. I think most of you know the health insurance marketplace notice. Often, it's got many names, including the exchange notice. It's really only required for new hires. Also note that there are 5 states. I didn't list them here, but there's 5 states plus Washington, D.C. that also require a notice. And that notice must be provided within 14 days of any new hire. There's also the notice of patient protections. That is only required if you're requiring selection of a primary care physician. And don't forget that under the ACA rules, a PCP can be a pediatrician, a PCP can be the OBGYN. Pay particular attention to those rules, but you will need to provide that notice so that your participants, beneficiaries, and enrollees who are enrolling know what would be required if they select that plan. And then there's the Medicare Part D credible coverage, which I'm sure all of you got out mid-October. So don't worry about that again till you have to do your CMS filing by the end of March or end of February. There is the notice for the women's health and cancer rights, and then there's the CHIP program. So those are just some of the ACA notices that you need to comply with. All right, so just moving on before questions and answers, I am sorry, but we are running out of time here. I wanted to touch on a couple things. We do have at the end of each external webinar, we've got where you can go look and keep up on executive orders, legislative activity, and judicial decisions. I have the links to those sites so that you can periodically go out there and keep apprised of what's going on. Of course, the big one that you see in the teal here is really about should those premium tax credits, will they be expiring at the end of December or not? We do know that the Senate has agreed to a vote again sometime in December. But again, the status of those premium tax credits for those above the 400% poverty line, it is uncertain. We also, if you notice under the judicial decision, we did talk about the upholding of the category A and Bs, and that even though those members of the task force were technically not appointed in a certain way and they were challenged, that the Supreme Court did uphold. And so you do have to continue to offer without cost sharing those category A and B preventive task force preventives. And of course, there's much activity going on with respect to Trump RX, and I have a slide quickly on that. I also have the website addresses for what I call lovingly the trifecta, and that's noted here. Um, and then again, this is ever changing. Trump RX and especially recent guidance on GLP-1. I think there's 5 manufacturers as of today that are participating. This really does not, at this point, have direct impact on employers. However, what we do know is when prices go down, say for Medicare and Medicaid, sometimes there is a shift to the commercial population. So it's not clear whether or not this will cause the employers to also have some transparency over costs so that it could reduce the prices of pharmacy even on the commercial side, or whether or not there will be a shifting where the pharmaceutical companies will try to shift costs. That's not clear at this point, and I'm not here to opine on that, but just know that that's out there. It could drive down the price of the GLP-1. I was recently at the International Foundation of Employee Benefit Plan seminar. It was a very good seminar on GLP-1. One thing to note is that the FDA is evaluating whether or not there will be a pill form as opposed to injectable. That isn't going to do anything with respect to the patent life, but it may reduce the cost. If you read some of the guidance, it looks like that it's a possibility that the pill form may be as low as $150 per month. We'll see who can receive it at that price if that happens. But the FDA has not approved that as of this point in time. And then lastly, just a quick reminder, gag clause. This is so critical. So first off, you need to determine who will be filing your gag clause attestation. For example, I did it at my former company for all of our clients as a TPA. And we did gather attestations from all of the networks. We also helped clients gather those attestations from the PBMs. Some of the PBMs put their attestations out on their websites. What's really important to you as an employer, identify who's doing it. And if no one else is doing it, then you can do it. It's super simple. It's a spreadsheet spreadsheet. It's pretty easy upload tool that's self-correcting. But really plan on doing it by December 15th, not by the 31st, because you do have to get a HIOS ID. And the person that actually submits the report is different than the one that attests. So two different individuals need to get IDs in order to do that reporting. So first off, know who's doing it. Maybe your PBMs, maybe your carriers, health plans, and TPAs are doing it. That's great. But it does not negate that you need to have all of those attestations on file. You need to have them and retain them should you get audited. That includes if you have many tiers to your network tiers, domestic, wrap networks, primary networks, friends and family networks, whatever they call clinically integrated networks. You do need to get all of those attestations. And again, we can help you if you have any questions on that. So again, next up, next meeting, Wednesday, February 25th. I know this was a very meaty content. I'm sorry, we are right at time. Please field your questions through your producers. Again, I wish for all of you a great Thanksgiving holiday season, and of course, the best open enrollment season. And thank you again for your business. I appreciate you. Thank you.